Hello, everyone, and welcome to today's discussion titled, Do Repeated Government Infusions Help Financial Stability? Evidence from an Emerging Market. I'm Kirsten Hamann. I serve as the Interim Director of the India Center at UCF, and I'm also a Pegasus Professor in the School of Politics, Security, and International Affairs, and an Associate Dean in the College of Sciences. It is an honor to welcome our speaker, Dr. Madhu Kalimipalli, to our India Center event today. The India Center at UCF broadens the understanding and awareness of contemporary India. It promotes the study of India in the world today and the relationship between the United States and India through partnerships, scholarship and research, education, and outreach. Today's event addresses a timely and important topic. As I'm sure you're aware of, India has recently surpassed China as the most populous country globally. Our discussion will focus on the impact of government infusions on financial stability, which is of core importance in large countries with emerging markets. Welcome again. Thank you for joining us today. And it is now my pleasure to turn it over to Laila Chakro, the Director of Public Affairs of the India Center, who will introduce our speaker, Dr. Madhu Kalimipalli. I hope you will enjoy the discussion. Thank you.
Thank you, Kirsten. Hello, everyone. It's a pleasure for me to introduce our esteemed guests today. Dr. Ishwar Venugopal is going to be moderating today's discussion. Dr. Venugopal is an assistant professor of finance in the College of Business at UCF. He received his Ph.D. degree from the University of Houston. Dr. Venugopal's research interests are in the areas of corporate finance, entrepreneurial finance, and fintech. Our speaker today is Dr. Madhu Kalimipalli. Dr. Kalimipalli is a full professor in finance at the Lazaridis School of Business and Economics, Wilfrid Laurier University in Waterloo, Canada. He is also an affiliated member of the Waterloo Research Institute in Insurance, Securities, and Quantitative Finance at University of Waterloo. Prior to joining Laurier in 2000, he was a visiting assistant professor at the Faculty of Management in McGill University. Dr. Kalimipalli holds a Ph.D. in finance from University of Houston. He has presented his work at over 170 venues, including several prestigious institutions and top finance conferences around the world. His research interests broadly include the areas of risk management and fixed income markets. Today, Dr. Kalimipalli will discuss the effects of government infusions on promoting financial stability and diffusing financial crises in India. There will be an opportunity for the audience to ask questions following the presentation and the moderated discussion. So please utilize the Q&A function at the bottom of the screen for questions. Now I will hand it over to Dr. Kalimipalli to start our discussion on do repeated government infusions help financial stability? Evidence from an emerging market.
Thank you, Leila. Thank you for a generous introduction. Are you able to see the slides?
Yes, we can.
Okay, perfect. So good morning, everyone. It's an honor and pleasure to join you this morning. In this work, we're going to be talking a little bit about the government infusions into the banks and what role specifically they may play in an emerging market context, in particular reference to India. So this is a joint work with Vijay and Shankar, who are based in Trent and Emory, respectively, and my PhD student Ola here in Waterloo. So I only have 20 minutes, so I'm just going to give you sort of an overview of what it is. And I kindly requested Leila to share the paper link, which has a lot more details, into the paper. So the setting is what we see in the business media about how India has been infusing capital into the state sector banks. And these are headline news events a couple of years ago. And these are massive amounts being injected into the big public sector banks such as Central Bank of India, Indian Overseas Bank, Bank of India, UCO Bank, and so on. And a lot of, in this particular Bloomberg story, talks about how the capital injection was done by investing in the debt issues of these banks. And the $2 billion amount was the amount that was being done in that year. And also at the same time, there was also talk about setting up a bad bank, which is basically a shadow bank that will take over the bad assets of or non-performing assets of these public sector banks and then refinance them through debt issuances to wider markets. And also in the recent post-COVID setting, there has also been talk about how the non-performing assets as a ratio of total advances have steadily increased around the COVID, and hence that begs for more capitalization from the government. And as you can see in the bottom picture, the pink bars show the actual amount of infusions that have been happening into these banks on a regular basis. So given this setting, this question of how government infusions and guarantees affect the overall financial stability has been a matter of intense debate among academics since the recent global financial crisis. And these interventions, by the way, have taken many forms, such as public government guarantees, recapitalizations that happened during the TARP injections during the GFC in US. GFC refers to global financial crisis. Government loans, subsidies, transfers, forbearance, which is really the relaxation of capital requirements, massive QE that was happening during COVID. So all these interventions have broadly then been put into, if you think about it, two types. One is where the government intervenes in a system-wide way, where the government is perhaps lowering interest rates or perhaps purchasing assets off the balance sheets through respectively conventional and unconventional policies. On the other hand, the government intervention can also be targeted to individual banks through one of those instruments, which is guarantees, capital injections, or asset restructuring. So given this setting, the research in US and Europe have primarily found that subsequent to a big capital injection following, let's say, global financial crisis, there was an increase in systemic risk on account of moral hazard incentives in the longer term. There might have been a short attenuating effect on the risk in the short term, but long term, undoubtedly, there has been an increase in systemic risk. And similar evidence shows up in Europe too, where in the European markets, where government interventions have been associated with subsequent increase in zombie lending and elevated risk in the banking sector. Zombie lending refers to lending to parties who are basically unable to pay at a later stage. So given this setting, India presents a very interesting example because India witnesses these capital infusions on a regular basis in order to stabilize the weak balance sheets of the public sector banks. So just to put this in context, we have US and India here, on a one-to-one comparison. You find that, for example, in the case of US, the capital infusions happen with respect to certain crises. So the most ubiquitous one was the TARP, which led to over $200 billion injection across a swath of public sector organizations, institutions, which are both private and public. Whereas in India, these happen irrespective of whether there is a crisis or not. And there are massive infusions that have happened over the last 10-year period. In our sample, we end the sample at 2018 because we started the study around 2020. But this trend continues even post 2018. So the thing about these repeated infusions is that they can either reduce the risk or ameliorate the moral hazard problem, or they can amplify the moral hazard problem. So, so just to give you some context, so this graph shows the steady increase of capital infusions in US dollar terms over a decade period. And we have seen generally a secular increase happening, especially towards the end of the sample. And if you put the year-to-year increases, these year-to-year increases have been massive, as you could see, at least in 3 of those periods, 10, 11, 15, 16, 17, 18, which also corresponds to some of the interesting economic crisis periods or policy regulations that were happening in India. So perhaps one could relate to the sort of banks which have played a huge role in the economic development, as well as have received substantial government infusions. So what you're seeing here on the left side is the banks, or is the list of banks who have experienced these capital infusions. And State Bank of India, obviously, and Punjab National Bank, these banks really are at the top of the receiving end. And on the bottom, at the right side, you have this pie graph, which shows that if you take the top 5 banks, State Bank of India, all the way to Indian Overseas Bank, these 5 banks account for 60% of the capital infusions. So there is a huge amount of concentration in terms of which banks are getting them. So given this setting, and this box whisker plot shows that these banks who are at the outliers typically are those who are receiving massive infusions, State Bank of India, Bank of India, compared to the rest of the sample. So, and this also shows the distribution of the capital infusions across time. So, given this basic data background, the literature broadly finds conflicting evidence on the relationship between government guarantees and subsequent bank risk-taking. So on one hand, government guarantees can actually increase bank value through one or more of these following channels, which is reducing asymmetric information between banks and markets, improving the credit ratings, and thereby lowering funding costs and increasing the franchise value for the banks, lowering the potential systemic risks of these banks, especially if they belong to this too big to fail category, by providing a downside insurance value to banks, especially during crisis periods, and improving the liquidity provision by the banks. So overall, these can actually increase the value of the banks. On the other hand, these massive injections can also lead to adverse consequences, such as excessive leverage, excessive risk-taking on account of the moral hazard problems, where the borrower increases the likelihood of runs distortions in the bank behavior. So the banks, therefore, are lending to more risky borrowers, and that can propel the bank towards a downward spiral. Or the banks could be using the their capital unproductively, thereby inducing a sector-wide or industry-wide productivity slowdowns. Finally, the counterparty risk to the guarantor. So guarantor is the government, arising from system-wide shocks and potential bailout costs for the taxpayer. So the fact that the banks may go down can actually transfer the risk to the government in this case, and can induce a sovereign risk. So therefore, the ultimate effect of government guarantees is an open empirical question. And then if you, so that's where the US evidence and European evidence do find that the government capital infusions do tend to be associated with increased risk-taking by banks in the long term. Now, India presents an even interesting setting because of the repeated capital infusions, as I alluded to, and these repeated capital infusions would have double-digit effects in the following sense. On one hand, at the top left, you see that the repeated infusions may help the government to improve the financial standing of the banks and lower the underlying risks for the banks. So, so they're helping the government to better reduce the risk for the banks. On the other hand, the undercapitalized banks are going to anticipate capital injection from the government, and hence have really weak incentives to implement any risk control mechanisms, right? So, so given this discussion, therefore, the effect of repeated government infusions on risk-taking by banks is an open empirical question, right? So, if the governments were to see if the government capital infusions are likely to improve banks, that's perhaps is going to happen through one or more of these channels, which is capital infusion, increasing capital infusion, increasing the bank portfolio diversification, or increasing the growth potential of the underlying firms, improving the cash holdings, or corporate hedging by the bank. So these are the various channels through which the top left corner is going to work. But on the other hand, repeated infusions can increase the moral hazard behavior, lower the incentives to control the risk, and encourage aggressive risk-taking, okay? So this is the sort of dichotomy we want to resolve in this paper. We study the possible effect of repeated government capital infusions and promoting financial stability through the lens of an emerging market. Now, so the question, therefore, is, do repeated government-sponsored capital infusions lower financial risk and improve the financial stability? Okay. And India is an interesting example because it went through a whole plethora of policy changes and shocks that happened. And as you can look at the slide, India presents an interesting example where there were massive infusions happening. NPAs were going up through the roof. NPAs refer to non-performing assets. There are multiple domestic policy shocks and regulatory shocks that India was witnessing. At the same time, a lot of non-financial companies in India were taking on huge amount of debt, corporate debt, and that also put the banks in jeopardy because the banks had relationships with these banks, so with these corporates. So overall, India is a laboratory in the sense that it went through a very interesting, complex, multiple shocks. So in the interest of time, I just going to forward and then bring some relevance into the study we were doing. So when I was presenting this at a regulatory body in India in April, I was brought attention to this news item, which basically which was put out by the CAG, the Controller Auditor General report, which said that a lot of these government infusions to big banks happened with a lot of in a loose way, right? So there was a lot of generous funding that happened, and then it talks about how the government capital infusions were actually so-called led to this indiscriminate lending during the previous government era. So what I'm trying to highlight here is that now the government is realizing, or at least the auditor is realizing, that a lot of these infusions were done somewhat indiscriminately, and that could have led to system-wide risks. So it sort of validates what we show in this paper. And then finally, the DD also talked about how CAG found several deficiencies in the recapitalization of public sector banks. So in some sense, it has been brought to regulatory attention, and only we provide a very meticulous study in this direction and provide a breakdown of what the different shocks were. So the data comes from various sources for this study. I'm just looking at the time here. I probably have, could you tell me, Ishwar, 25 minutes? Perhaps, yes. So,
10 minutes. Yeah.
Sorry?
10 minutes.
Okay, 10 minutes, great. So to conduct this study, we really need a sampling framework where we think of these public sector banks that have been infused with capital as treated firms, and then we form control banks in 4 different ways. These are government public sector banks who are not receiving infusion that year, or private banks who don't receive infusion at all, or public or private NBFIs, NBFIs refer to non-banking financial institutions or non-banking financial corporations, who are basically shadow banks referring to the fact that they don't take deposits, but they are very active in the Indian setting. So these are all 4 different control samples we use to process this study. So I just want to give you some in broad brush what is happening to the sample. So we only have 24 banks, big public sector banks in India, who massively are involved in this economic transformation, if you will. Then there are these 16 private sector banks, and there's non-banking financial institutions or shadow banks. We have 11 of them who are public as in government has a stake in them, and private, which are privately traded. And we'll take the top 25 of them. Okay, so the overall sample is limited, as you can see, compared to hundreds of banks that you have in the US or a European setting. And that itself is the first challenge to execute this study, given a smaller sample size. Yet we are trying to tease out these delicate economic phenomenon, if you will. A simple univariate sample setting. So what we are trying to do is compare the banks across various dimensions. And what we find is that the treated banks, these are the banks, public sector banks, who are receiving huge capital infusions from the government. They have significantly larger assets and deposits. However, they're undercapitalized, have lower interest coverage ratio, implying high interest rate obligations, lower profitability, and lower market to book valuations compared to their benchmark control samples. So you can see the flavor of how these banks look different compared to their peers. To execute this study, we use a whole set of risk measures. For example, for the systemic risk, we use the measures that are mentioned here. In the interest of time, I just want you to, you can look at the details in the paper, but broadly, these are capital shortfall measures or the value at risk measures. The way I want you to think about it is this, that if the overall market is underperforming or is having a bad time by being in the bottom 5 percentile of the performance, how is an individual bank going to be affected? So the capital shortfall refers to how the overall market underperformance is affecting the underperformance of a given bank. The conditional value at risk goes the opposite way, which shows if a single bank is underperforming, how is that going to incrementally increase the risk for the overall system? The network risk measure captures how the increasing possibility that the banks may be increasingly connected, and hence one bank going down may enhance the risk for the rest of the system. Okay? So we use we deploy a whole bunch of metrics. And what I just want to show you is one or two plots so that you can sort of relate to what I'm talking about. So this present graph here looks at the probability of default of the underlying banking system grouped into those 5 groups I talked about. So one is the treated group. So the treated groups are the banks who are receiving capital infusion, and the rest of the groups are different control banks I mentioned. Okay? And what I want to bring your attention to is that overall, in the historical time frame, we see that the probability of default on the left panel, or the probability of default slope, which is the long-term default risk as a difference between 5-year and 1 year, those are much far higher for the treated banks compared to the control banks. So it seems that these banks who are receiving capital infusion are to begin with have higher default risk. And then the time series gyrations seem to be associated with several macroeconomic events that were happening in India at that time. And then similar trends appear when we look at the systemic risk measures too, in that broadly, the treated banks have higher capital shortfall compared to the rest of the control samples. And the network risk, the same story repeats. Okay, so you sort of now see how we build these measures. What I'm presenting here are firm level, bank level measures aggregated across each group and with a time series trend. So with that intuition, the main workhorse, therefore, in this paper tends to be the DID, so-called DID panel regressions, where we are actually studying how post-treatment, post-capital infusion, how the treated banks perform versus the control banks in a 2 to 3 quarter time frame. And the basic result, these are very robustly estimated as shown in the paper. The basic result that comes out is, in this case, we are regressing, we are using probability of default measures as a dependent variable. And I want you to just focus on the last two regressions, 4 and 5, and similarly 9 and 10. What we are showing here is that once we control for all the firm fixed effects as well as quarter fixed effects, the effect of capital infusion on the treated banks significantly goes up. It has a positive significant sign. And that is true for probability of default 1 year from now, and a longer probability of default expectation over the 5 year. Similar results emerge when we also use systemic risk measures, where we see that the systemic risk now, as in capital shortfall, as well as network risk, significantly go up post-infusion for the treated banks. Now, this result, we stress tested it in many, many, many ways. And bottom line is the result holds. So if you use a more robust quarterly regression framework, again, the results hold, because here we're using a more precise control sample based on the quarter before the infusion. Again, the results are very robust here in that you see, so you see that the default risks go up significantly post-infusion. And not only that, the large infusions, large here refer to the fact that the infusions are larger in size compared to the overall, also deliver an increased default risk on the system. So, and that result carries on to the systemic risk measures, both the capital shortfall as the network risk, as well as the network risk. Okay. So in summary, what do we then document so far? We find that the treated public sector banks experience significant increases in both default and systemic risk 2 quarters following in capital infusion. And moreover, the large-sized infusions seem to significantly aggravate these default and network risks. And these results are economically significant in that the effect of these shocks on the underlying risk account for a significant portion of their corresponding means and standard deviations, right? So having presented that main result, so Ishwar, how much time do I have?
A couple of more minutes.
Okay, so great. So so we stress test this result using a more so-called propensity score matched control sample, a better calibrated control sample. We then use not 5% tail risk, but 1% tail risk. So these are extreme tail risks that go into the production of our systemic risk measures. We then use public sector control samples. So these are public sector banks who are not receiving capital infusion that year. We use endogeneity in several ways and as an additional robustness check. And then we also use alternative control samples, that is the public sector and private sector NBFIs. And then we also use alternative network risk variables, alternative definition of post-infusion, alternative measures of capital infusion size, and so on. And all the baseline results that I documented still hold. Okay, so I'm just going to take 30 seconds and then wind this up. So having established that result, then we ask 2 additional questions, which is are any of these results mainly driven by the stress period funding that happened? So those boxes there refer to those 3 years, which increased massive injections on account of the macroeconomic developments that are happening. So we want to ascertain if those were the 3 periods that were driving the systemic risk. And the result we obtain is that, in fact, yes, it seems like infusions during those periods actually lead to lower overall risk measures, but then the fundamental average risk effect we talk about still prevails. So the overall effect still does not go away, in that the overall infusions are still associated with the increase in these risk measures. Then we also test what are the different firm level channels that are driving this. Again, the key finding here we have is that basically the infusions are followed by significant increases in default and systemic risk for both high risk as well as low risk banks. So high risk banks defined by low tier one, low diversification, low market to book, etc., take on additional risk or their risk parameters go up, as well as the low risk banks defined by low leverage, high interest rate coverage, etc., they also experience higher risk following infusion. So our evidence sort of points to a moral hazard story that's happening by Indian banks, as banks expect that these infusions are going to happen anyway, so let me take on more risk. Final bullet here, we want to study how this increase in infusions are actually affecting the overall aggregate risk. So do government capital infusions help lower aggregate sovereign and default risk? This is important because when government infusions are happening on a massive scale, the solvency of the banks, in turn, is going to determine the sovereign risk of the government. So in case the banks are going to be facing down tail events, that risk is going to be transferred to the sovereign, and the aggregate risk is therefore going to be affected. So basically, we study if the aggregate risk aggregated at different levels, such as public sector banks, private sector banks, etc., that spread here. So here we're measuring this default risk spread between the public sector banks and the private sector. That spread is in turn going to be affected by the overall infusion. Infusion is measured by the fact that if infusion is happening in a certain quarter, or if large number or dollar amount of infusions that are happening in a given quarter. Our results overall show that it seems like the infusions are actually, there is some evidence that the overall default risk seems to be going down, especially the long-term default risk. You can see there is a decrease happening. So which means government infusions overall are reducing the default risk of the public sector banks overall, but we don't see any such changes happening at all for the overall systemic risk. Okay, so this is one slide story, a summary. Then the key takeaway is this: that based on an exhaustive sample of government capital infusions in India, given its peculiar setting, we don't find any evidence that it actually lowers systemic risk. If at all, we see the risks are going up, which are also economically significant. The evidence broadly points to moral hazard story, which is a similar story that holds up in the US and European system, except that India is a very different economic machine. And therefore, our paper contributes to better understanding of the role of government guarantees in attenuating these financial risks and improving the financial stability in emerging markets. Thank you.
Thank you very much, Madhu, for an enlightening presentation. So the way we are going to work this out is I have a few questions for Madhu. And once we get them over with, we'll open up the discussion to the audience. But the audience can always feel free to leave their questions in the Q&A box over there, and I'll pick them up when we move on to the audience section. Right.
So, one question: should I leave the slides on, or should I stop sharing?
It's up. Yeah, let's stop sharing actually. So if you don't need them.
Okay.
Yeah. So just to set the stage, since a lot of our audience are from the US context, so the Indian banking system is actually quite different compared to the US, right? So if you can actually give us a sense of what are the key factors, distinguishing factors when it comes to the Indian banking system compared to that in the US. So to set a broad picture.
Yes, a great question. So in India, Indian banks also have a welfare mandate because a lot of these disadvantaged sections of the so-called unbanked sector, they are not really profitable for the private banks to reach. So the public sector banks take on this welfare mandate on them, and hence invariably government gets involved in that because the government is also promoting welfare. So what I'm therefore alluding to is that the failure of public sector banks is not something that you see can happen, because the governments are providing this massive put option to the banks to survive, and at the same time be servicing the welfare mandate, if you will.
Okay. So would it be fair to say that bank runs are much less common in India compared to the possibility in the US, given that we recently had one?
Yes, absolutely. I think absolutely. Governments are very proactive in reaching out to the banks and bailing them out. Absolutely.
Okay. So just to give a little bit more of context, actually, given the main crux of your paper is that there's a lot of capital infusion happening. So India historically has had this problem of non-performing assets. So this problem has been there at least for a couple of decades now. If you can give us a sense of what actually led to this situation, that the capital infusions were needed and going forward.
I mean, there's a political dimension to some of this. I think my own, I think, private conversations with bankers and regulators perhaps have, led me to believe that the banks are smart enough. Their managers can perhaps lend where it is profitability for the banks. The fact that banks are public sector banks are under the mandate of the government, they may be lending to certain sectors where ex ante there is a possibility of these zombie loans turning out. So I think that is really the source of the problem. The second is that the fact that the banks did not know how to categorize zombie as in non-performing loans, was a big problem until the Bankruptcy Regulation Act was brought in around 2016, 17. And that led to the identification of some of this. So the answer to your question is, why is NPAs happening? I think a lot of it is probably because of government intervention. And I think the big second point is the big change in this seismic setup was actually the bankruptcy law, which provided a way for the banks to recognize some of these are NPA and hence put them in that category and slowly move them out.
Maybe it is actually better to, if I take one of the clarification questions from the Q&A section over here. So the question was, can you tell us what exactly is non-performing assets? Because it seems people don't understand that. So if you can give some more clarity, that will help us, everybody.
I think non-performing is simply inability. I don't know the accounting parameters bank use, but as an economist, I would like to think of them as where the recovery rates are low, and hence the banks are therefore adjusting the terms of the loans, either in terms of the coupon or in terms of the maturity of the loan or principal over a much extended period. So where the banks therefore adjust the terms of the loan in order to make the recovery feasible.
Perfect. Thank you. So moving on to the main crux of your paper. So your paper shows that government capital infusions into public sector banks are typically associated with higher default risk, and these banks are making a lot more risky investments. So what exactly is happening here? Are banks lending to, let's say, risky failing government institutions in sort of a quid pro quo situation, or is it just banks are taking on more risk so that they can achieve higher returns and then get out of under this capital infusion cycle? So out of the two things, what's actually happening over here?
Yeah, so one of the so when we do these propensity, when we do these probit models, what we realize is when we ask a question as to what are the key drivers of government capital infusion happening for a given bank, it seems like the tier 1 ratio, the fact that the banks are undercapitalized is the main determinant, right? So the fact that the bank is undercapitalized today is likely to better predict whether capital infusion is going to happen. Now, the fact is, why is there undercapitalization happening, right? So undercapitalization is happening either because the loans or the asset side exposures are very risky, A, or B, there is less capital access for some reason, right? So what I mean is, therefore, if you go to the asset side, maybe banks are taking extra risks on their balance sheet. Now, what are these extra risks? Extra risks are ex ante loans which should not be given in the first place, or where the sort of so-called ex ante probability of default is very high, or the banks are perhaps taking on or lending into sectors where there is a higher mandate from the government. So I think the risky loans, which is boosting up the riskiness of the asset side, is therefore denting the tier 1 capital. So that's one reason tier 1 capital is low. Then the question is, from the balance sheet, from the liability side, maybe the capital markets are pricing these bank shares or bank tradable assets at a higher premium. So the capital is hard to come by. The recapitalization is hard for these banks. So that is being met through government. So I guess the answer to your question is, what is happening here is a lot of it is actually coming through the riskiness of the loan side, as well as the inability for the banks to raise capital outside the government market. So most of the institutions are investing in the public sector banks, or in turn other public non-bank financial institutions, for example, LIC, right? These are banks, these are non-banking financial institutions who are government-owned. They are infusing capital. So I hope that broadly answers your question, Ishwar.
Yeah, it does. So stepping away from public sector banks for just a second. So in 2008, we saw that around the financial crisis, a lot of capital actually, or depositors fled from private sector banks. And most of these depositors actually ended up putting their money in public sector banks. So there's this recent paper by Acharya and co-authors where they actually claim that this is actually flight to safety and not flight to quality. So they argue that this actually worsened the credit quality of public sector banks, but at the same time, it actually benefited to a certain extent the private sector banks, because they started becoming more and more efficient in how they run. So your paper is about cash infusions, and you again point out the fact that these cash infusions also did not help this particular setup. The public sector banks became worse off.
Yeah.
So let's say if you were in charge over here, you were a regulator, what are the few key items that should have been addressed by the regulator when this was happening? Or what has worked so far, in your view?
No, I think it's a great question. So what the Virals et al. Paper talk about is sort of crowding out that was happening. So in the sense that the public sector banks were witnessing huge deposit inflows. At the same time, the private banks were experiencing deposit outflows, right? So this crowding out by public sector banks happened during these critical times where the government guarantees were supposed to have a bigger value, right? So so the second point there is that from the regulators, right? So how would regulators look at this? So the Indian banks, public sector banks, have this twin mandate of being welfare oriented, because there are these unbanked sectors in the economy. With 1.34 billion population we have, there are huge unbanked sectors. I mean, US also has the same problem of unbanked sectors, incidentally, but India also has this wide inequalities, and the welfare mandate is a very important mandate for the public sector banks. And then they need to balance that with the efficiency, right? And given the way, so the politics definitely needs to enter into this equation. So sometimes the politicians may be myopic in their goal setting for the banks. So the welfare mandate may also lead to leakages of the loans that are maybe happening. Okay, so bottom line, the banks are trying to manage their welfare mandates, at the same time trying to be efficient. Private banks don't have the welfare mandate, so it's very easy for them to be efficient, right? So where, as a regulator, what perhaps we could do is reduce the leakages perhaps that are happening. So when I meant leakages, there are also loans that were made by the public sector banks to these rich corporates. And there are all these anecdotes and stories of how these rich corporates who took loans from the banks never repaid, and they declared bankruptcy and they're living high life, right? So I think those zombie loans which are made to rich corporates perhaps could have been dealt with heavily, and I think that perhaps is a way to prevent leakages from happening in the banking system.
Right, perfect. Thank you. So talking about NPAs and the way the Indian system works. Indian banks have recently reported excellent earnings, actually. So in fact, it has never been better compared to the last 20 years. And there is also a report that's saying that the non-performing assets that are being held by commercial banks in India is nearly at a 7 to 10-year low at around 3.9%. This is still high compared to the US, where it is only 1.2%.
Right.
But it's a historical low for the Indian banks compared to, let's say, they were around 12% as of 5 years ago.
Right.
So, but this is all happening at a time when the US banking system and in general, the West is going through a lot of turmoil. Right. The recent runs in the US and the recent UBS debacle and all of those things.
Right.
So what are the implications for the Indian banking sector, especially considering that we are living in a globalized world and these shocks can have an impact on India? And should we expect any volatility in terms of cash flow or slowdown at the Indian banks?
Right. It's a great question, Ishwar. So it's really about the cross-border capital flows and the relationships across banks. So I'm going to give you 2 or 3 bullets there. So first is that the only way a massive shock to a banking system in a developed world such as US would affect the Indian banks is through the cash flows of the underlying corporates. So what I mean is that if the corporations that are borrowing from Indian banks are also witnessing a shock to their cash flows and earnings because of a wider slowdown that's happening in the West as in US and so on. So these shocks to the earnings of the corporates are going to be affected domestically too, as in Indian companies. And when the corporates are affected, that is going to affect the balance sheets of the public sector banks. So there is definitely a link how the underperformance in the wider sense in the Western markets can be transferred to the Indian banks through the shocks to the underlying earnings of the corporates. The second thing is the capital. So there's a good chance that the foreign institutional investors, remember I said before that there is a huge investment community in the West that includes mutual funds, pension funds, who are investing massively and lending to the Indian financial markets. And that could be happening to corporates, banks, and so on. So to the extent that the Indian public sector banks depend on these foreign institutional investors, there could be a shock transmitted. But usually the withdrawal of foreign capital, if happening out of India, is replaced by domestic financial institutions who are buying them out, right? So I don't think the capital shock is going to be as massive, that is on the liability side, as much as on the asset side. So the only way the Indian banks, therefore, are going to be in trouble, or the risks are going to be transferred from the US markets to India, is through the underlying corporates. And if the corporates, and a lot of corporates, as we know in India, are borrowing heavily in the US markets through both Yankee debt and 144A debt and bank loans. So any of those corporates, therefore, diminished performance from them could affect the Indian banking system.
Okay. Thank you. So if you want to think about this, it's primarily through indirect channels through which, if at all, if there's any impact, right?
That's
right.
correct.
Yeah. So a final question from me, and then we'll open up to the audience. So looking ahead, let's say for the next 10 years, what do you see would be the biggest challenges for the Indian banking sector and by extension, the Indian economy?
Yeah, no, it's a great question. I think, especially given what is happening in China, with the meltdowns and so on. I think definitely, the bankruptcy law and the regulation that has been brought about is a big landmark in the Indian banking landscape. So the financial discipline of the public sector banks is going to be the major story. So that discipline comes through, as we said, asset side management, somehow government distancing itself, right? And so these are easier said than done. So I think, to me, the headline story would be the discipline of the public sector banks, because as the audience here would know, the sovereign risk of India is measured by the default risk of the State Bank of India. So in other words, if any risk of State Bank of India, any risk would affect the balance sheets of the State Bank of India, that in turn is going to mirror the overall sovereign risk of India. And the sovereign risk of India is going to be affected in an adverse way. That is going to affect the overall cost of borrowing for all corporates, if you will. So I guess the key headline would be the discipline of the public sector banks going forward, at the same time trying to balance the welfare objectives and not be swayed too much by the political interventions.
That makes sense. Thank you. We'll open up to the audience. You can always leave your questions in the Q&A box. I'll start with one that we have over here. So what factors determine which public sector banks receive more money than the others? So
Great question. In fact, we have a model there in the paper. Basically, it seems like the tier 1 ratio. Tier 1 ratio is the equity capital that banks have. A weaker bank equity capital seems to be the main driver for capital infusion in the following period. There's also evidence that if a certain bank is subject to higher risk of a policy uncertainty that's happening in the country, and if that uncertainty is going to affect the volatility of the underlying bank earnings, that also is going to be determining the capital infusion next period.
We have one more question over here. So the question is, do the same risks persist in these shadow banks when the government infusion is happening? So
yes, great question. So the public sector shadow banks, called public sector NB and non-bank financial institutions, had a big meltdown, perhaps, in 2017-18. In fact, it happened after our sample. So I would say it happened in 2018-19. So the story there was this ILFS, which is the Leasing and Finance Corporation, invested massively in the capital projects to do with buildings, roads, and capital construction. And they had massive capital inflows or investments happening in Japan, from Japan, Middle East, and so on. So this public NB and NBFI faced a Lehman kind of a meltdown because they were not simply able to service their debt. Okay, and so there the government had to again come in and bail them out. So the answer to your question was the infusions into NBFIs were not common, unlike banks, which happen every year. But there was an episode way back in 17-18 where there was a massive growth in these NBFIs, primarily through lending to infrastructure. And for some reason, infrastructure tend to have a longer payback period, and they were unable to service the debt. And there was a risk that, and that particular institution, ILFS, was systematically important, too big to fail institution. So government had to step in and bail them out. So I believe I answered your question. So I guess your question was, does the same logic apply to to the shadow banks? My answer is absolutely. But thankfully, NBFIs did not need, especially public NBFIs, did not need such kind of infusions until a Lehman kind of event that hit them in 2017-18. But I think things are definitely much better there.
We can take one more final question, and the question is from Anne Solar. So the question is, what does the future hold for India's banks, actually?
Right.
In the current context.
I mean, as I said, I think Indian banks are very solid. And I think in the following sense that I think, there is a huge, first of all, there's a huge clients they're servicing right away. They got about 1.3 billion population. So obviously, I think the Indian banks are smart. They know how to manage their risk. I think so. The future is really about how government steps away from them and not intervene in them, and somehow balances the welfare objectives of the bank with the profitability. So a lot of it is about how governments evolve and set up firewalls between between government intervention into these banks, government intervention into the central bank, that is Reserve Bank of India. So the firewalls really is the big sticker thing. If somehow the governments invent better discipline, in how they operate, I think Indian banks have a tremendous future to evolve and grow well.
All right. Thank you so much. With that, if there are no other questions, we'll pass it on to Leila.
Thank you, Dr. Venugopal, for leading this educational discussion today. And thank you very much, Dr. Kalamapalli, for providing insight on the issue of government capital infusions in India. I really appreciate you both taking the time to speak with the India Center at UCF today. And I will be sending out a link to Dr. Kalamapalli's paper to our attendees. And thank you to our attendees for tuning in today and participating. And we hope to see you again soon at our next India Center event.
Thank you so much, Leela. And again, thanks to all the audience.
Thank you. Thank you so much. Right, I'm signing off.